Types of annuities. There are two major types of annuities: fixed and variable. Fixed annuities guarantee the principal and a minimum rate of interest, generally interest credited and generally interest credited and payments made for fixed annuities are based on rates declared by the company, which can change only yearly. Fixed annuities are considered general accounts assets. In contrast, variable annuities account value and payments are based on the performance of a separate investment portfolio. Thus, their value may fluctuate daily. Variable annuities are considered separate account assets. There are a variety of fixed annuities and variable annuities. One example, the quality indexed annuity, is a hybrid of the feature of fixed and variable. Annuities. It credits a minimum rate of interest just as other fixed annuities do, but its value is also based on the performance of a specified stock index, usually computed as a fraction of that index total return. In December 2008, the Securities and Exchange Commission voted to reclassify indexed annuities with some expectation as securities, not insurance products. Annuities can also be classified by marketing channel, in other words, whether they are sold to group or individual. Annuities can be deferred or immediate. Deferred annuities generally accumulate assets over a long period of time, with withdrawals usually as a single sum or as an income payment beginning at retirement. Immediate annuities allow purchasers to convert a lump sum payment into a stream of income that the policy holder begins to receive right away. Long-term car insurance basics. Long-term care insurance pays for services to help individuals who are unable to perform certain activities of daily living without assistance or require supervision due to a cognitive impairment, such as Alzheimer's disease. Features of long-term care policies. The best policies pay for care in a nursing home, assisted living facility, or at home. Benefits are typically expressed in daily amount with a lifetime maximum. Some policies pay half as much per day for at home care as for nursing home care. Others pay the same amount or have a pool of benefits that can be used as needed. Criteria for the beginning of payments. The policy should state the various conditions that must be met. They can include: point number 1, the inability to perform 2 or 3 specific activities of daily living without help. These include bathing, dressing, eating, toileting, and transferring, or being able to move from place to place or between a bed and chair. Point number 2, cognitive impairment. Most policies cover stroke and Alzheimer's and Parkinson's disease, but other forms of mental insapacity may be excluded. Point number 3, medical necessity or certification by a doctor that long-term care is necessary. Most policies have a waiting period or elimination period. This is a period that begins when an individual first needs long-term care and lasts as long as the policy provides. During the waiting period, the policy will not pay benefits. The policy pays only for expenses that occur after the waiting period is over if the policyholder continues to need care. In general, the longer the waiting period, the lower the premium for the long-term care policy. Benefit periods for long-term care may range from 2 years to a lifetime. Premiums can be kept down by electing coverage for 3 to 4 years, longer than the average nursing home stay, instead of a lifetime. Most long-term care policies pay on a reimbursement or expense insured basis up to the policy limits. In other words, if the policy has a $150 per day benefit but the policyholder spends only $130 per day for a home long-term care provider, the policy will pay only $130. The extra $20 each day will in some policies go into a pool of unused funds that can be used to extend the length of time for which the policy will pay benefits. Other policies pay on an indemnity basis. Using the same example as above, an indemnity policy would pay $150 per day as long as the insured needs and receive long-term care services regardless of the actual outlay. Inflation protection is an important feature, especially for people under the age of 65 who are buying benefits that they may not use for 20 years or more. A good inflation provision compounds benefits at 5% a year. Without inflation protection, even 3% annual inflation will, over 24 years, reduce the purchasing power of a $150 daily benefits to the equivalent of $75. Six other important policy provision. Point number 1, elimination period. Under some policies, if the insured has qualifying long-term care expenses on one day during a 7-day period, he or she will be credited with having satisfied 7 days toward the elimination period, the time between an injury and the receipt of payments. This type of provision reflects the way home care is often delivered, some days by professionals and some days by family members. Point number 2, guaranteed renewable policies. These must be renewed by the insurance company, although premiums can go up if they are increased for an entire class of policyholders. Waiver of premium. This provision ensures that no further premiums are due once the policyholder starts to receive benefits. Point number 4. Point number 4. Third party notification. This provision stipulates that a relative, friend or professional advisor will be notified if the policyholder forgets to pay a premium. Point number 5. Non-forfeiture benefits. These benefits keep a lesser amount of insurance in force if the policyholder lets the coverage lapse. This provision is required by some states. Point number 6. Restoration of benefits. This provision ensures that maximum benefits are put back in place if the policyholder receives benefits for a time, then recovers and goes for a specified period, typically 6 months, without receiving benefits.